Welcome to the Smash Property Market Update for April 2025. We put together a investor report, which I'm going to go through. And this is not going to be your typical market update. There's no suits and ties and words that you can't understand. This is just the real deal of what we are seeing out there in the market. And I'm going to relay this to you in as plain English as possible, so you as investors can go out there and make the right decisions. Obviously, none of this is financial advice. All of this is data from CoreLogic, Australian Bureau of Statistics, data that we've collected over the month and the year, as well as a few other bits and pieces that we put together to make this as comprehensive as it possibly can be. We'll start with a helicopter view of what's actually happening across the Australian property market, and then we'll sort of start to drill down into areas that I think will be beneficial for investors at different price points, also with investors that have different strategies. I've got my notes here, so if you see me looking down, this is the notes that I've got here on my phone from the report. Looking at the property market as a whole, the national prices are up. They're up for 2 months in a row, up 0.4%, which means that buyer sentiment is changing out there in the market. We've obviously seen the rate cut from the RBA in February. Not a huge cut, but it's given people a bit of confidence. They can see a bit of optimism on the horizon, and it's given a bit of a boost. Obviously, rates come down, more people have a better borrowing capacity, which is getting more buyers off the sidelines. People are starting to just feel a little bit more confident with going out there and buying properties. And we are seeing that not only from the data here, but also in certain markets, you're starting to see a lot more buyer activity when it comes to open homes and placing offers and things like that. But let me be clear. Is this the start of a boom? No. Is this 2021? No. Growth is happening, but it's slower. It's patchier, and it's much more dependent on picking the right market. You know, in 2021, you could have just bought anything and it would have grown in a huge amount of value, but this is different. We've got some, heavy emotional owner-occupied buyers in Sydney and Melbourne, which is reflective in some of the data that I'm about to go to. So let's have a look at what this data is actually telling us. And have a look at the capital city home values. And this is data from CoreLogic. We have Sydney leading the charge with a median value of 1.19 million, which is up 0.9% annually. But in the last month, it's up 0.3%. Melbourne is up 0.5% month on month, but over the last 12 months, annually, it's actually down 2.6%. So there is a little bit of a recovery there. You've got a lot of people sort of speculating, is now the bottom of the cycle and is Melbourne starting to pick up? But we will keep an eye on that as the months progress. Brisbane, which is my favorite market, annually it's up 8.6%. Month on month, it is up 0.4%. Adelaide had a massive year, as along with Perth. They're both up annually 11%. But in the last month, Adelaide is leading the charge over Perth, being up 0.8%, and Perth only up 0.2%. So just looking at that, you can definitely see that Perth, there's a bit of growth there, but it has started to slow and slow significantly on what it once was. Canberra, month on month up 0.2%, but over the annual, the last year is actually down 0.5%, along with Hobart. Also went backwards last month, and overall down year on year, 0.2%. Darwin is an interesting one. This is up 1% month on month. Annually, it is up 2.6%, but you can see Darwin's median value is the lowest of all the capital cities across the country, so there's huge affordability there, and there is also some very strong signs of good rental yields there as well, which we will get into. Now, when we look at regional markets are still outperforming capital cities on an annual basis. So collectively, regional markets are up 5.3% year on year versus 2.8% for capital cities. They are ahead, but that gap is narrowing, and we're keeping our eye on Melbourne in particular to see how much of a chunk that city takes out on that gap. Top performing regional markets right now: Townsville is up 25% year on year, 23% year on year. Gladstone up 22%, Mackay up 20%. The Central Highlands in Queensland up 21%, and you've got Geraldton, which was an interesting one. Geraldton up 25%. Now, my take on this, guys, is that Geraldton, that's a buyer's agent bubble, and I know which buyer's agent that is. And these things happen, and we've got to be very cautious. You have these high volume BAs, they'll target specific areas. In my opinion, they've targeted Geraldton because of affordability, because of the supply constraint. They're buying there for a reason, don't get me wrong, but then they overinflate the market, which is kind of what I'm seeing in the numbers here, because there's no way I'm buying in Geraldton for myself or clients at this point in time. But Queensland stuff, sure, makes sense. Population movements, etc., makes sense. But Geraldton, who the fuck's moving to Geraldton? I mean, nothing wrong with Geraldton, but I mean, I can look where it is, man. Like, well, who's going there? That's an interesting one. Beware of a buyer's agent bubble. Overall, though, jokes aside, these areas do have very tight supply. There's a lot of rental pressure on the Queensland towns I just mentioned. There's a lot of infrastructure pipeline, and it's still affordable. So you got a lot of people buying there. I love Queensland. I'm a big advocate for Queensland as it relates to property investors. But I guess a big question is Perth and Adelaide still worth it? Now, questions that we do get reasonably often still. Now, obviously, looking at the numbers we just looked at, they've been the hot picks for the last 12 months. We've had, 11% growth year on year, and the numbers are obviously backing that up. But here's my honest view in that the growth is still there. There's no doubt about it. But it's slowing. You're not too late, but you've got to be sharp about where you buy and what you buy. No longer are the days of just buy anything and it's going to double in Perth. You've got to be very careful. Perth's supply is still quite tight, hence why we still have that pressure on pricing as well as rents. But there are a lot of pockets in Perth that are just overheated. In my opinion, they are overpriced. So we've got to be very careful about suburb selection. Don't be wrong, the upside is still there, but you've just got to be very careful about what it is that you buy. And, if you're looking for growth, particularly in a Perth market, like I said, you've got to be pretty precise with it. And we've got to look for value pockets where the fundamentals of property are still there, because there are certain areas which still offer good value from a growth and a rental yield perspective, but you've just got to be very, very, very careful there. I'm not buying there for clients at the moment, but that doesn't mean to say it's a bad investment. It's just, in my opinion, we've had the run. We're looking at other markets across the country. Adelaide, much the same in my opinion. If you're going to Adelaide and you're set on that market, look for the more affordable areas. Most likely it's going to be on the northern side of the city, and there are still some good value pockets there for sure. But just be very careful. Don't expect it to have, another 10, 11% growth year in 2025 into 2026. And now for the juicy, where to focus. Now we put this together just to make this easier for, the DIY property investors out there. And again, just looking here at my notes here. So if you're looking for growth, there's still a case you can argue for Adelaide and Perth. But don't just follow the herd. You need to target value suburbs where there is genuine infrastructure, gentrification, and a tight supply. It's really the tight supply that is going to give you that growth in the short term. You can still argue a case that Adelaide and Perth are affordable, and there are some good areas. Personally, I wouldn't really be recommending it. For me, if you're looking for growth, and you've got, 800 plus something thousand, 800,000. Brisbane is the quiet performer. It's sort of, we had this nice growth run, over the last couple of years through COVID. It's sort of got quietened down a little bit by Perth and Adelaide, but it's still ticking away. That market is still very tight. We've got the Olympics on the horizon. We've got lots of infrastructure projects going on through that southeast sector of Queensland. The Sunshine Coast is one of the hottest markets in the country right now, obviously just north of Brisbane. And yeah, it's got strong internal migration, and I'm a big fan of Brisbane. If you can afford to get into that market, I highly recommend it. If that's a little bit too pricey, as in the 700-800s are, regional Queensland, in my opinion, we've had a lot of growth there. There's no doubt about it. But I'm a big believer in that the growth cycle, we're still in the up stages of that growth cycle. So places like Townsville, Gladstone, Mackay at the right price point, Rockhampton, Bundaberg at the right price point still have room to grow. These areas are very affordable. They're tightly held. There's a lot of jobs there. Rental market is pretty tight on supply, and I really do believe that until sort of prices start to get into that $700,000 range, I still think there's tons of value in these regional markets. Like I said, until they sort of hit the 700 mark, I'd be backing away. But under that price point, it's beautiful. Now, if you're looking for cash flow, if you're looking for cash flow in a residential property at the moment, you're not really going to get it. When we're talking about freestanding houses in a market where you are, not going to be taking on too much risk. There's not really a positive cash flow, investment property out there as it relates to just stock standard freestanding homes. But if you're looking for strong cash flow, Perth in certain areas is pretty good. You're probably not going to get a freestanding house that's going to cash flow too well, but apartments at the right price can cash flow very well. Now, Darwin, we're looking at around 6% yields in Darwin at the moment. So Darwin, keep an eye out because it's very affordable. The rental yields there are quite high comparative to other capital cities. If Darwin's not your cup of tea, then and you want a cash flow around the 5-6%, regional Queensland, regional WA, regional South Australia all have great yields in and around the 5 to 6% mark. And again, this is just freestanding houses that we're talking about here. There are obviously other investments that you can do outside of just your stock standard freestanding house with one tenant. We don't do that. I don't believe in it. But if you're after that, there are higher risk, higher rewarding cash flow properties out there that we do not touch, but I'm aware of them. And if your budget is under 500K, you're priced out of capital cities when we are talking about freestanding houses, but you are not priced out of the game. Regional Queensland, like I keep saying, there's some great options under the $500,000 mark that tick both boxes for yield and growth. I'm still buying heavily in Queensland. I love it. And I think there's some great opportunity there for the remainder of 2025. We'll keep a tab on that as the months progress. If your budget is around the $800,000 mark, you're in a really good position and you've got options. So for that $800,000 mark, give or take, you're sort of looking at entry-level prices for houses in Brisbane or Adelaide with a solid upside for growth. Or you're looking at townhouses or smaller homes in the middle and outer rings of Sydney and Melbourne, which are showing there's a bit of growth there. There's a bit of activity there post rate cut. Like I said in the start of the potty, you've got emotional owner-occupied investors that are looking to get into the market in those areas. Like I said, the middle and the outer rings of Sydney and Melbourne, the townhouses and smaller homes are around that price point. Wouldn't recommend it for property investors, but if you're an owner-occ in those markets, that might be for you. Or here's what I would do. I would take that $800K, I would split it down the middle. I would go and buy two $400,000 properties in different regional growth corridors. And that's my take on if you've got $800K. So The final word here is that there is opportunity, but it's not everywhere. The noise is back. The media is pushing the rebound, but the smart investors are not buying into the hype. We're not wishing and hoping for a growth run like 2021. We're just looking at good fundamentals with consistent, repeatable wins stacked over time with the lower downside risk. That's my personal preference. I don't like to take huge amounts of risk. Obviously, we're taking a big risk as it is. So we want to keep it as lower risk as we possibly can. Hence why I said I stay away from all of these, what do you call them? The fucking, I just had a mind blank. I see it every day. What are they? Not the dual ox. They're the fucking multi-tenant fucking, what do you call them? I've lost my mind. I don't know, but they're basically it's basically where you have a house and you chuck like 5 different tenants in it. I don't know. See, I don't care about it. That's how much I don't pay attention to it. It's gonna kill me now. Give me a sec, guys. I got to look this up. This is gonna kill me. I have to do this. I know I've got a few minutes here. Co-living. That's right. Fucking co-living. I don't do the co-living stuff. It promises high yields. There's a lot of risk. There's a lot of tenant risk. There's a lot of insurance risk. Some lenders look at that as a commercial lend, not a residential lend. Therefore, your rates potentially can be different. So the promise of cash flow, look, in some pockets, I'm sure it does work, obviously, but just for the average punter out there, for me, it's too high risk, and the reward is cool, bit of cash flow. Who cares? It's about growth, right? So co-living, I avoid. I avoid NDIS. I don't touch defense housing. Not saying it's bad. It's just not for me. Very restrictive. That's why I just like the idea of just having a freestanding house. Where I own it, right? I can do whatever the hell I want with it. Along with, if your house is sort of out of reach, then hey, these older style apartments serve very, very well as well. Now, that is a very high level property market update for April 2025. Like I said, there is opportunity out there, but you've just got to be careful. Don't get too wishful and hopeful that we're going to have another growth run like 2021. We will have growth, but just not, that 20% year on year type stuff that we've seen. If you're ready to jump into the market and you don't want to do it alone, this is where we come in handy, right? So if you want a partner who's built property portfolios, who's retired from the workforce, who's done, all the things that you're looking to do, hit us up. smashpropertyinvesting.com.au. We're on socials, Insta, Facebook. I think we're on TikTok and LinkedIn. Reach out. Happy to get some deals done. Get you closer to the goals that you're looking for, and really building a portfolio that suits you rather than just buying another property. It's really, really important to get that right in the beginning. So I hope you got some value out of that. Any questions or comments, leave them down below. Happy to get back to you. Until next month with the property market update, hope you guys stay safe, enjoy, make some money, build your wealth, and we'll catch you next time. Take care.